Want to invest in mutual funds? Then it is most important to understand the various mutual fund types and the benefits they offer. तो देर किस बात की, let's get started. Based on asset class, number 1, equity funds. Equity funds primarily invest in stocks, hence it is named after it. They invest the money collected from various investors from diverse backgrounds into shares or stocks of different companies. So simple. The profits and losses associated with these funds completely depend on how the invested shares perform in the stock market. Remember that equity funds have the potential to generate significant returns over a period. Hence, the risk connected with these funds also tends to be comparatively higher. Number 2, debt funds. Debt funds invest primarily in fixed income securities such as bonds and treasury bills. Keep in mind, securities उसे ही बोलेंगे जिसका वैल्यू है और उसे खरीदा जा सकता है, right? Okay. They invest in various fixed income instruments such as fixed maturity plans, liquid funds, short-term plans, long-term bonds, and monthly income plans. Since the investments come with a fixed interest rate and maturity date, it can be a great option for passive investors looking for a regular income with minimal risks. Number 3, money market funds. Investors trade stocks in the stock market. In the same way, investors also invest in the money market, also known as capital market or cash market. The government runs it in association with banks, financial institutions, and other corporations by issuing money market securities like bonds, dated securities, and certificates of deposits, among others. The fund manager invests your money and gives regular dividends in return. Opting for a short-term plan not more than 13 months can lower the risk of investment considerably on such funds. Number 4, hybrid funds. As the name implies, hybrid funds is an ultimate mix of bonds and stocks, thereby it connects the gap between equity funds and debt funds. The ratio can either be variable or fixed. In short, it takes the best of two mutual funds by a simple distribution. For example, 60% of assets in stocks and the rest in bonds or vice versa. Hybrid funds are suitable for investors looking to take more risks for debt plus return benefit rather than sticking to lower but steady income schemes. Now, based on investment goals. Number 1, growth funds. Growth funds usually allocate a considerable portion in shares and growth sectors, suitable for investors who have plenty of extra money to be distributed in riskier plans. Number 2, income funds. Income funds belong to the family of debt mutual funds that distribute their money in a mix of bonds, certificate of deposits, and securities, among others. Managed by skilled fund managers who keep the portfolio in control with the fluctuations rate without compromising the portfolio's strength. Income funds have historically earned investors better returns than deposits. They are best suited for a risk-averse investors with a 2 or 3 years perspective. Number 3, liquid funds. Like income funds, liquid funds also belong to the debt fund category as they invest in debt instruments and money market with a tenure of up to 91 days. The maximum sum allowed to invest in 10 lakh. A highlighting feature that differentiates the liquid funds from the other debt funds is the way the net asset value is calculated. The NAV of liquid funds is calculated for 365 days including Sundays, while for others only business days are considered. Number 4, tax saving funds. Equity linked saving scheme over the years have climbed up to the ranks among all categories of investors. Not only do they offer the benefit of wealth maximization while allowing you to save on taxes, but they also come with the lowest lock-in period of only 3 years. Investing predominantly in equity and related products, they are known to generate non-tax returns in the range 14 to 16%. These funds are best suited for salaried investors with a long-term investment horizon. Number 5, aggressive growth funds. Slightly on the riskier side when choosing what to invest in. The aggressive growth fund is designed to make steep monetary gains. Though subject to market volatility, one can decide on the fund as per the beta. Beta is the concept that measures the expected move in a stock relative to movements in the overall market. For example, if the market shows the beta of 1, an aggressive growth fund will reflect a higher beta, say 1.10 or above. Number 6, capital protection funds. Capital protection fund serves the purpose while earning relatively smaller returns, say 12% at best. The fund manager invests a portion of the money in bonds or certificates of deposits and the rest towards equities. Though the probability of incurring any loss is quite low, it is advised to stay invested for at least 3 years to safeguard your money, and also the returns are taxable. Number 7, fixed maturity funds. Many investors choose to invest towards the end of the financial year to take advantage of triple indexation, thereby bringing down tax burden. Based on structure. Number 1, open-ended funds. Open-ended funds do not have any particular constraints such as a specific period or the number of units which can be traded. These funds allow investors to trade funds at their convenience and exit when required at the prevailing net asset value. This is the sole reason why the unit capital continually changes with new entries and exits. An open-ended fund can also decide to stop taking in new investors if they do not want to. Number 2, closed-ended funds. In closed-ended funds, the unit capital to invest is predefined. That means the fund company cannot sell more than the pre-agreed number of units. Some funds also come with a new fund offer period wherein there is a deadline to buy units. Number 3, interval funds. Interval funds have trades of both open-ended and closed-ended funds. These funds are open for purchase or redemption only during specific intervals decided by the fund house, and also no transactions will be permitted for at least 2 years. These funds are suitable for investors looking to save a lump sum amount for a short-term financial goal, say 3 to 12 months. Based on risk, number 1, very low risk funds. Liquid funds and ultra short-term funds are known for its low risk, and the returns are also low, 6% at best. Investors choose these to fulfill their short-term financial goals and to keep their money safe through these funds. Number 2, low risk funds. In the event of rupee depreciation and unexpected national crisis, investors are unsure about investing in riskier funds. In such cases, fund managers recommend putting money in either one or a combination of liquid, ultra short-term or arbitrage funds. Returns could be 6 to 8%, but the investors are free to switch when valuations become more stable. Number 3, medium risk funds. Here the risk factor is of medium level as the fund manager invests a portion in debt and the rest in equity funds. The net asset value is not that volatile and the average returns could be 9 to 12%. Number 4, high risk funds. Suitable for investors with no risk aversion and aiming for huge returns in the form of interest and dividends, high risk mutual funds need active fund management. Regular performance reviews are mandatory as they are subject to market volatility. You can expect 15% returns, though most high risk funds generally provide up to 20% returns. Specialized mutual funds. Number 1, sector funds. Sector funds invest solely in one specific sector, theme-based mutual funds. As these funds invest only in specific sectors with only a few stocks, the risk factor is on the higher side. Investors are advised to keep the track of the various sector-related trends. Sector funds also deliver great returns. Number 2, index funds. Suited best for passive investors. Index funds put money in an index. A fund manager does not manage it. An index fund identifies stocks and their corresponding ratio in the market index and put the money in similar proportion in similar stocks. Number 3, international or foreign funds. If investors looking to spread their investment to other countries, foreign mutual funds can get investors good returns even when the Indian stock markets perform well. Number 4, real estate funds. Despite the real estate boom in India, many investors are still hesitant to invest in such projects due to its multiple risks. Real estate fund can be a perfect alternative as the investor will be an indirect participant by putting their money in established real estate companies or trust rather than projects. Number 5, inverse or leveraged funds. While a regular index fund moves in tandem with the benchmark index, the returns of an inverse index fund shift in the opposite direction. It is nothing but selling your shares when the stock market goes down only to repurchase at an even lesser cost and hold until the price goes up again. Last but not the least, exchange traded funds. Thank you so much for watching this video. See you in the next video.